Imagine this. You have to decide where to put your savings. One option is a government bond, safe, reliable, but with a low interest rate. The other option is to buy stocks, riskier with ups and downs, but with the promise of high returns. It would be logical to think that, in the long run, the two would balance out. And yet, history tells us otherwise. For more than a century, stocks have yielded much more than bonds. So much so that economists call it the equity premium enigma. But how is this possible? Why does the market reward the risk in stocks so much? And more importantly, what does this mean for our financial future? Today, we're going to dive into one of the greatest mysteries of modern economics. Chapter 1. The beginning of the enigma. At the end of the 20th century, economists Rajneesh Mehra and Edward Prescott published a study that stunned the academic world. They found that since 1889, U.S. stocks had returned an average of 6 to 7% annually, adjusted for inflation, while bonds had returned a mere 1 to 2%. This seemingly small difference adds up to enormous returns over time. How could investors prefer safe bonds when stocks have historically been a long-term gold mine? This is where the puzzle began. Chapter 2. Risk versus reward. The classical theory. The traditional explanation is that investors are risk-averse. If you buy stocks, you can lose everything in a crisis. Bonds, on the other hand, although they pay less, are more stable. According to the theory, the higher return on stocks is a premium that compensates for that risk. But here's the problem. The numbers don't add up. The difference between the returns on stocks and bonds is so great that even the most extreme risk aversion can't justify it. It's as if someone paid you too much for a small risk. Chapter 3. The psychology of fear. Some economists believe the explanation lies in our minds, not in the math. People hate losing money much more than they enjoy earning it. This bias, called loss aversion, can lead investors to prefer bonds, even if stocks offer more long-term benefits. In other words, our psychology keeps the equity premium alive. But is this explanation sufficient to justify more than 100 years of data? Chapter 4. Hidden factors in the economy. Others argue that equity premiums reflect risks we don't easily see. Wars, economic depressions, pandemics. When you invest in stocks, you're exposed to everything bad that can happen to the economy. And while things are going well on average, this extreme risk, even if it occurs rarely, makes investors demand more reward. Perhaps the story of growth and progress is misleading. Behind it lies a catastrophic risk that always lurks. Chapter 5. The role of patience and time. But there's something even more fascinating. Equity premium isn't a mystery to those with patience. If you look at short periods, stocks seem volatile, dangerous. But when we look at decades, they almost always outperform bonds. Herein lies a key lesson. The real reward isn't for those who seek quick profits, but for those who know how to wait. Equity premium is, in a way, the reward for patience. Chapter 6. What if it's all a mirage? Not everyone is convinced. Some economists say that perhaps the equity premium we've observed is a product of unrepeatable historical circumstances. The rise of the United States, the technological revolution, the growth of globalization. In other words, the future may not repeat the past. What if the next 100 years are nothing like the previous ones? Chapter 7. The impact on your life. But beyond the theory, the equity premium poses a personal decision. Should we take more risks in pursuit of higher returns, or accept security even if it means less growth? The answer depends on each individual, our life horizon, our risk tolerance, and what we truly value. Peace of mind or the potential to build something bigger. The enigma of the equity premium reminds us that the economy can't always be explained with simple formulas. It's made of numbers, yes, but also of fears, hopes, and collective stories. And perhaps that's the real lesson. Markets aren't machines. They're reflections of our human nature. As long as we remain who we are, the mystery of why stocks outperform bonds will continue to haunt us, challenging economists, investors, and dreamers alike. Subscribe and discover more secrets of economics and history that impact our present.